Welcome to Get Rich Education. I'm your host, Keith Weinhold. In today's high property appreciation landscape, how do the 5 ways that real estate pays you look now exactly? Then we're going deep on how to lower your property insurance premiums, which will increase your cash flow, yet still get adequate insurance coverage. Learn why property insurance premiums have gone up substantially in some parts of the nation since last year, and what's the one insurance-related document that you should never sign today on Get Rich Education. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Framingham, Massachusetts to Birmingham, Alabama, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Some property insurance rates have increased a lot, and some haven't. My insurance premiums have shot up more than 20 to 30% on some of my single-family rental properties. Then I have property in other states where the premiums really only had increases that were about indexed to inflation. Now, if you're like most people, what you do is you escrow your property tax and insurance obligations, and you just roll it all into one monthly payment that you make to your bank or your mortgage servicer, of course, known as PITI, Principal, Interest, Taxes, and Insurance. Of course, when we break down your PITI, well, your mortgage interest payment, the first I, that shrunk. That payment shrunk thanks to the Fed and their artificially low interest rates. We recently had Tom Wood right here to discuss how to lower the T in PITI and contest your property taxes. Today, we're talking about how to reduce your monthly payment in the second I of PITI, your property insurance rate, with things that you can do in both the near term and your long-term strategy. Before we drill down on that and do some learning about insurance, now, when it comes to the 5 ways that real estate simultaneously pays you, some of those profit centers are going to be higher during some seasons and some lower. Let's just estimate what your return was this past year if you bought, say, a turnkey property at greturnkey.com. So a property that cash flows, even if it just cash flows a little, for a new purchase. And of course, you bought it with that all-important debt on it, like an 80% loan-to-value loan.
We load 16 tons, and what do you get? Another day older and deeper in debt.
Yes, exactly. You get another day older and deeper in debt. Well, that would actually be a good thing around here. Good debt is a good thing at GRE. We leverage that to build wealth. And what is that song? Is that Johnny Cash? What is it? You get 16 tons? Or no, you load 16 tons, and what do you get? Another day older and deeper in debt? Is that some analogy about mining coal? I don't know what the 16 tons is all about. I think it has something to do with mining. But getting back to the 5 ways sort of revisited here and updated for what's happened in this past year. And all right, gosh, this is going to sound really lofty. This is really going to sound inflated and over the top to the uninitiated person. Now, to the new listener here, you just got to be warned, because this is going to result in a pretty high-flying ROI, because compared to history over this past year, the first of 5 ways you're paid with appreciation, that's way higher than normal. The second one, cash flow, is likely lower than normal. The third one, principal paydown made by your tenant, well, that's higher now due to your lower interest rate because more of your tenant's payment goes toward principal for you and not lost to interest. The fourth, tax benefits, they're mostly unchanged. And then the fifth one, inflation profiting. Well, that's higher now because the rate of inflation is higher. So then let's do that. Let's add up your ROI over this past year from a property that you bought at greturnkey.com, just say 12 months ago. Well, over the last year, 15% home price appreciation. That's actually kind of conservative. Gosh, and 1 year ago, who really would have thought I'd be saying that now? Let's just use 15%. When your turnkey property that you bought, say 1 year ago, goes up in price, that 15% and your leverage 5 to 1, you got a 75% return on your down payment. How did that happen? It happened because you're leveraged, meaning that you got a 15% return on both your down payment and on the bank's money. Then on top of that 75%, we'll say just add on a 4% cash-on-cash return from the cash flow. We'll say that it was small because property prices have run up faster than rents proportionally over the last year. Well, that's a 79% ROI for you now. Then with today's low mortgage interest rates, or one that you would have gotten a year ago in this example, let's just say you got a 4.5% mortgage interest rate, with the tenant paying down that principal for you, that would be another 6% return to you. And we got that number by dividing the total amount of principal that the tenant paid down on your property by your down payment. Plus the tax benefits are conservatively 5%, plus the rate of inflation, since that's been higher this past year. It debases the nominal value of the debt that you owe back to the bank. Let's just say that's another 5% return for you. Add up the 5 ways for what's happened over the last year, then just roughly you have a 95% rate of return, which is something that sounds so high-flying that a lot of outsiders would not understand that. A lot of lay people, unengaged persons, a dilettante, a greenhorn, they would think that that entails some inordinate risk to accumulate a 95% total ROI with the 5 ways that you're paid. But because you do have multiple profit centers, it's really exactly for that reason that this really high ROI was actually achieved with less risk. Because say if 1 or 2 of the 5 profit centers falter, well, you still have 3 or 4 others. And this is largely why we do what we do here at GRE. This is the architecture of how wealth is built with buy and hold real estate. When you buy turnkey property right, and you don't even have to be the flipper, you don't have to be the rehabber, you don't have to be the landlord, but there are a few things to manage. Even if you have a property manager, maybe there's some emails between you and your property manager, but it is quite manageable for the investor the vast, vast majority of the time. And now this 95% total ROI, that's clearly not sustainable over time. Like I discussed last week, with more housing inventory coming onto the market, that could probably set up for slowing appreciation. But even over the long term, even over future decades in your investor life, and through future boom times and through future recessions, anything less than a 20 to 25% annual rate of return is actually disappointing, and it's with less risk because you know how to make your money do 5 jobs at the same time, not just 1 job or not just 2 jobs like most investors. And those investors, we're being kind by calling them investors, they're really just speculators. Congratulations, you are a true investor. Coming up here on the show in the near future, as I've mentioned earlier, the 50th anniversary of the depegging of the dollar from the gold standard is coming up really soon on August 15th. That's because it was August 15th, 1971 that President Richard Nixon stated that creditor nations could no longer redeem their American debt for gold. America wasn't going to give them gold anymore. They were only going to give them dollars. Well, in 2 weeks, Robert Kiyosaki will be back on GRE here with me to discuss the relevance of this upcoming 50th anniversary and how it ushered in a new era of monetary inflation to America. You can look forward to the greatest selling financial author of all time, and of course, the author of Rich Dad Poor Dad, Kiyosaki, and I together again, this time for that anniversary 2 weeks from today. And for that particular show, I would imagine that Robert and I will touch on real estate, but that show will really probably be more about the topic of money than it will about real estate. Hey, be sure to sign up for GRE's free Wealth Building Don't Quit Your Daydream letter. It is now available. It's free at getricheducation.com/letter. And what's been in that letter lately to make it so great? Well, video of Tom Wheelwright and I that accompanies the podcast here. An update about our provider in Florida and in Alabama and in Texas and in Tennessee that have available brand new construction turnkey rental property. A lot of our letters have actionable opportunity like that for cash flowing property. Other valuable material in the email letter lately included my personal reaction to higher inflation and how you can flip that over and use it to build wealth. Also, my thoughts on whether I think that 1031 exchange is really going to die or not. A great calendar of upcoming financial events that you're going to want to know about. And, sometimes people wonder where I get my information from. I shared that with you in the letter recently, where I get the numbers about the best Census Bureau feedback for real estate investors, and the Federal Reserve meetings, and the inside scoop on the eviction and foreclosure bans and their expiration, and how the end of extra unemployment compensation is going to affect the economy and your tenants and more. Get it all in the letter. And even if you think that you might ever want to work with GRE, yes, come with us and work on our side. I made a key hire here last year and another one this year as GRE keeps growing. And both of those openings were announced in the letter. So that's where you'll find out about that too. Sign up while it's on your mind. It is free. Get it all at getricheducation.com/letter. Let's talk to Doug Fudge about how to best navigate the property insurance landscape today. This week's guest founded Fudge Insurance with his father, Paul. Today, he is the president and CEO of Fudge Insurance. Together, they've built a thriving insurance agency and growing staff. Doug is also past president of the Independent Insurance Agents of Central Florida. They are the same people that also presented at our 2019 Tampa real estate field trip. That was Lori that presented there. Well, today, her boss, Doug, is here with us. Welcome to GRE, Doug Fudge.
Thank you for having me. I appreciate it.
Doug, before we talk about the industry and how one can get good coverage and yet pay a low premium, what types of properties do you insure and what's your particular geography, even though we're talking to a national audience here?
Our agency is located in Central Florida in the Orlando area. We insure all over Florida. We also insure in a half a dozen other states. And so we're an independent agency. We're a brokerage. So we give our clients choice. When you come to us, we have multiple carriers that we can work with to try to find you the best price and policy and coverage. Our specialty and our niche is investment properties, whether that's long-term rental or short-term rental. We are well-versed in those worlds, and we try to make sure that the customers that we have that buy those types of properties are well taken care of and well insured.
Go ahead and tell us, what are those other states besides Florida where you insure property?
We are in California, Colorado, North Carolina, Tennessee, Georgia, and Kentucky. I had to think through my map in my head.
Yeah, we have a few investor-friendly states there in that lineup. I often think of insurance as something that a person buys, but yet they hope that they don't have to use it. And a lot of times, I think an insured person's perspective is that they want to pay a relatively low premium and yet get the best coverage. So there are really a few ways to parse that, Doug. Oftentimes I think, well, when an investor is better off and maybe they have a lot of income streams in their life, they might be appreciative of getting a high deductible on a property like $5,000 means that they would have to come out of pocket for the first $5,000 themselves if there were any sort of event, but then they'd get a lower premium for that. And then investors that are more financially fragile, they might prefer a low deductible like a $1,000 deductible with a higher premium. What are your thoughts that way when it comes to some of the trade-offs between coverage and premium amount paid?
The old adage, you get what you pay for, is true. Obviously, the higher your deductible is, the lower your premium is going to be. And it's a trade-off. So if you have a lower deductible, your premium is going to be a bit higher. In my point of view, from an investor's point of view, if you're able to afford a higher deductible, there's not a really reason to go with a lower deductible because it does save you some money. We want to keep in mind that a insurance policy is not a maintenance policy. It's a, oh no, I had an accident policy. And so if you view it that way, you're really insuring for the worst case scenario, pipe bursts and floods the house, or your roof is blown off in a hurricane, you have a fire, that type of thing, and not necessarily wear and tear because wear and tear is not covered by an insurance policy. If you think of it that way, then you're not going to make a claim typically when it's lower dollar things that you could just take care of out of your cash flow.
Yeah, that makes a lot of sense. And I think for a prospective person that's out there looking for insurance, sort of like you touched on, Doug, for something to be covered, it really needs to be considered an event that's sudden and accidental, meaning that it was not something like a slow leak that caused damage over a number of months, because those sorts of things often are not covered in by insurance. So if your roof caves in like merely from old age and not storm damage, then it's not going to be covered.
That's correct. Yeah, sudden and accidental is the key. That's actually an insurance term, and that's the definition of what a covered claim looks like.
Of course, there are different types of coverages. Oftentimes we think of how one could be covered for the full replacement cost of a property, which can be better than only being covered for the actual cash value of property, but yet to be covered for full replacement costs. I typically think of that as something that's going to cost you more in premiums than what the actual cash value coverage would be. So can you talk to us about some of those coverage trade-offs between things like full replacement costs and actual cash value, and if there's any other considerations there, Doug?
Full replacement cost is kind of a misnomer. So replacement cost is going to be, I bought it 10 years ago and they're going to pay me for it as if it was actually new. Actual cash value is going to be, they're going to pay me for the depreciated amount. So replacement cost would be, we have calculated as the agent how much it would take to replace your house. So let's say $250,000. That's what the coverage is. You're going to get paid if you had a full-on fire, it burned the house to the ground, they would pay you up to that $250,000. If it costs $275,000 to replace the house, you're going to have to eat that extra $25,000 if that makes sense. So we want to make sure on the front end when we're insuring a property that we're all in agreement of this is how much the house would take to be replaced. We're using software to calculate that on our side, so we're taking into account the square footage, the age of the home, the features, everything that goes into the house, and that software spits out a number. And then we want you to agree with that number. We want you to say, yeah, I think that's right, or I think that's low, or that's high, and then we can work to make sure that you're properly covered in a level that you feel comfortable with.
How might an investor know whether they really are insured up to the full replacement cost? Are they just looking at that algorithm, that number that you supply them with? Of course, a lot of the material cost increases we've seen with supply chain disruption can factor into this as well. So can you talk to us more about if one wants to be sure that they're adequately covered if the entire structure burnt down to the ground and they had to rebuild it such that they would not have to come out of pocket with anything? How does an investor make that decision?
It's a good question. So it does come down to the software that the insurance companies provide. So we want to make sure that we have accurate details from the client when we're taking the information to run the quotes. So that's why it's important to get with your agent and make sure that if there's been any updates to the house, if the property appraiser's records don't match what the actual square footage is, that type of thing. If there's been an addition that's not on the property appraiser, anything like that, that you're letting your agent know so that they can calculate properly that number up front.
And of course, what we've been talking about here, Doug, is the improved portion of a property, often which might be 3/4 of the value of the entire property with the property in the land. Sometimes people have questions about the land. Does the land get insured, or is there ever any reason to insure the land at all,
Sure.
or only the improvements?
The land does not get insured. Part of that calculation will not be the land. Now, if you have a vacant lot, we can insure that for liability. You're not going to insure dirt.
Insuring dirt only maybe in the case of liability, maybe if there were a neighbor kid that came over and hurt himself or something like that.
That's correct.
Well, we've been talking about the cost to go ahead and replace a structure. Of course, with what's happened in the world beginning last year, it caused an awful lot of disruptions to supply chains that resulted in material cost increases and so on. So over, let's just say, the past year and a half, or maybe a little longer than that, Doug, what kind of changes have we seen to the insurance industry when it comes to cost of coverage and premiums?
The cost of coverage has gone up. Some because of the material cost. Obviously, when we're doing those calculations, that's going to figure into those because they update their software on a regular basis to make sure the current building cost, that's being calculated properly. The material price increases come into play that way through the replacement cost that we're calculating on the front end.
I know in some of my rentals that I own in Florida, I've seen premiums go up year over year of 20% or more. I've heard about in some cases that the premium's increasing by 40%, which can really help negate some of these low mortgage rates that we're getting. So can you talk more about the magnitude of the price increases that we've seen in the last year and a half or so?
Right now in Florida, everyone is getting a rate increase, myself included.
Yeah.
Mine went up over $1,000 this year and obviously wasn't happy about that. But right now we have an issue where insurance companies are being frivolously sued by lawyers and roofers over presumed storm damage. There's some gray areas in the insurance policy and people smelled a payday. And so, unfortunately, the insurance companies have been inundated with claims that are inflated 50, 60% over what they used to be. For example, if they used to get a claim for $15,000 for a new roof saying that there was hail damage, now it'll come in at $30,000, $40,000. And you multiply that by hundreds and thousands of claims coming into the insurance companies, it causes a problem. They're not a bottomless pit of money. They have a certain amount of money. And so in order to keep up and stay actuarially sound, they've had to raise their rates. And so it's affected every insurance company in Florida. We're hoping that rates will come down in the next couple of years. The legislature passed some legislation this past term in Florida that will hopefully ease some of that, but it wasn't sweeping legislation that would just take care of the problem.
Yes, I've been reading about some of that proposed legislation. When we drop back and look at the heart of the issue, Doug, after an event, if someone puts in a $30K roof claim, but it really only costs $15K, why doesn't the insurance company just say, oh, no, that's 2x market value. We're not going to insure for more than $15K.
When they do that, that's when the lawyer gets involved that the roofer has on hand. And then part of the problem was if the settlement on the claim was $1 more than the insurance company said it should have been, it settles for $1 more, then the lawyer could include all of their fees and other charges into the settlement, which elevated it and made it really high. And so that's one of the things that they tried to work on this year to make that more of a fair system. It's very complicated, but that's the nuts and bolts of it.
Okay, that's the crux of what the legislation aims to change, and that's part of what's resulting in higher premiums. Well, that's some of the bad news, and that's what's on the downside for an investor that's looking to get insured. On the flip side, though, there are probably some different things to consider from an insurance perspective before an investor buys a rental. With regard to insurance, can one get a lower rate, Doug, say if there's a different construction type, whether it's a block type of construction property or a new property versus a resale property, or anything with the roof type that one could look for in order to get a lower insurance rate? Not that insurance rates are going to drive the investor decision completely, but it's just one thing to consider.
Sure. When you're looking at a property, if it's concrete block construction, it's going to have a lower rate as opposed to frame. Obviously, it doesn't burn as easily, it doesn't blow over as easily, and so the insurance companies will give a better rate for that. The closer you are to the coast, the higher your premium is going to be. So the further inland and the further north in Florida you are, the lower your premiums are going to be. And the roof shape matters. So if you're buying a house with a hip roof, So if you think of a pyramid, it slopes down on all sides, and that's a hip roof. Not that it comes to a point, but that every side of it slopes down. The wind rolls over that much easier than it would a gable. So if it hits that gable, it could peel the roof off if there's a hurricane. So a gable roof has a higher premium than a hip roof. If you take into account the construction type, the shape of the roof, and the age of the home, or if it's an older home, if it's had recent updates, those things will help buyer to be able to lower their insurance premium every year.
These are all good things to consider. And when it comes to getting cash flow from a long-term rental, just in general, the northern half of Florida works better than the southern half of Florida. So that's something that's in an investor's favor. And typically those properties that are more inland are the ones that are going to provide long-term cash flow, more so than the ones right on the coast, which are more likely to be in the short-term rental pool. Doug and I have a lot more to discuss, including what's excluded from an insurance policy, what is not covered, and more. You're listening to Get Rich Education. Our guest is Doug Fudge. We're talking about property insurance for real estate investors. More when we come back. I'm your host, Keith Weinhold. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the number one lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to Get Rich Education. We're talking about something that I don't think we've specifically focused on for one particular episode in Get Rich Education history, and it's an expense that really every real estate investor has, and that's that property insurance. Your lien holder is going to be sure that you have insurance. You do need to have a lien holder involved because you do want leverage on this property. We're talking with Doug Fudge. He's the president and CEO of Fudge Insurance. We're talking about property insurance through the investor perspective on a national basis, but he is based in Central Florida, so he can speak to that as well. Doug, on a national basis, a lot of times perhaps a new real estate investor or someone that has not owned property before just doesn't understand the basics of exclusions. For example, coverage due to floods or earthquakes are often separate policies outside of a homeowner's policy or outside of a landlord's policy. So what can you tell us about exclusions and what investors need to be aware of there?
There are exclusions. Every policy has them. There's never a policy that covers everything. But some major ones are, just like you said, flood and earthquake. You're not going to have coverage for either of those in your policy that you're going to buy to cover your property. If you are in an earthquake zone, it's recommended. So you can get an earthquake policy. You can get a flood policy. There's two ways to get a flood policy. One is through the National Flood Insurance Program, the NFIP, which is the National FEMA-run insurance program for flood. That's the most common, and different insurance carriers administer those policies. So you might have NFIP policy, but it would have Progressive on it, for example. It's run through them. The second way is it's becoming more and more popular for home insurance companies to have private flood. So there are some that are endorsing flood onto their policy as an optional buy-in. If you have your home, you can get it either way. When you're going to have it endorsed on the policy, most likely those are going to be in areas that are not special hazard flood zones. So every house is in a flood zone. If your house is going to flood in a less than 1 in 100 year flood, you're in a special hazard flood zone. So that's how they mark that out.
Yeah, it's certainly something to keep in mind as to what is not covered, therefore what could be added on. Why don't we talk about what is covered? What are some of the things that specific to landlords' policies that are covered, Doug?
Your biggies, fire, lightning, wind, are going to be covered. Your main perils there. You're going to be covered in your liability for slip and fall. So someone's on the property, they fall downstairs or they trip in the backyard and you're sued as a landlord. Your liability insurance will defend you and pay out any claim up to your policy limits if necessary. What's not covered again are dog bites typically. So most landlord policies don't include any animal liability. So if your tenant has a dog, it's a very good idea to have them provide you with proof of renter's insurance with animal liability included on it. That's something that we run into quite often.
Oftentimes, savvier landlords have it right in the lease agreement that their renter needs to maintain an active renter's insurance policy.
That's right. There's a new program that has come out recently where they actually combine the renter's insurance into the landlord's policy, and then you can pass on the fee to your tenant. And that way you are quite positive that they have coverage. Because a lot of times somebody will provide you with a certificate of insurance. They paid for a first month or two, and then they cancel the policy, and you're satisfied. Yeah, you're satisfied for the year thinking that they have coverage, but they don't. So this new policy that's come out recently, this new product actually allows you to control that. And it also, they can include their animal liability if they do have a dog.
That's right. And one additional thing that some investors and homeowners like to do, and this includes their property, but it also goes beyond that, and that is add an umbrella insurance policy, a separate policy where benefits can potentially kick in beyond the maximum coverages allowed by the various insurances in their life, like property insurance and auto insurance and so on. So do you have any thoughts with respect to umbrella insurance and the role that that might have in a real estate investor's life?
Always have one. Our advice as an insurance agent is to buy as much coverage as you can afford. We look at risk and mitigation, and so if you are well covered with an umbrella, then that will help you to sleep easier. So with a dwelling fire policy, which is a typical policy type for an investment property, there's two ways to get an umbrella. One is a traditional umbrella, where you cover your primary residence, your car, your boat, your RV, rental properties, vacant land, all on one liability policy that overshadows everything and will cover everything. The other is a premise-only umbrella policy. We sell lots and lots of premise-only umbrellas. So you buy property A, we write a hazard policy for it. That's your dwelling fire policy, and we cover it with an umbrella. We write property B, we do the same thing. We write a hazard, we cover it with an umbrella. If you don't have a pool, less than $200 a year for that umbrella policy. It's very inexpensive. It'll give you $1 million of extra coverage. And so if there's an event on the property and you're sued, you have a lot of coverage for very little dollars.
Umbrella coverage, basically a backup coverage in that investor's life for things that go beyond just their property. And oftentimes the premiums are really low.
Yes, they are. They're not used as much as the primary policy. The rate on them is very low.
Now, I know part of the insurance rate increase problem that we were talking about before the break, Doug, has something to do with an assignment of benefits. This is something that people need to be more aware of. What is an assignment of benefits? Why is that important?
Assignment of benefits, it's in multiple states, but it's meant for a good reason. So it's in the policy originally because, for example, you have an elderly mother and she can't make decisions on her property, but she has a policy and she has a claim. Well, the assignment of benefits actually lets her assign the claim to you, and you can take care of things legally on her behalf. That's what it was intended for. The way it's been twisted in Florida is you have a claim, say a water damage claim. The plumber shows up and they say, here's the estimate. We'll take care of everything. Just sign this assignment of benefits and we'll take care of everything. We'll file the claim for you. We'll do all of it. Well, that's all well and good until that plumber or remediation company takes off after they've cashed out your settlement, or they jack up the amount of the settlement way beyond what it should be and what it would take to actually fix the property. You have no legal right to your claim after you've signed the assignment of benefits. You have 48 hours to rescind it if you talk to your agent and they talk you out of it. But once it's past that time limit, you legally do not have the right to the claim, and you will not get paid directly for the claim, and it goes on your record. It's not a great thing. So we try to tell all of our clients that if they call us and say, hey, I've had a roofing claim or a plumbing claim, we say, do not sign an assignment of benefits. The insurance company wants to pay you. That's what they're there for. They want to help you with that claim and make you whole. Contrary to what most lawyers will tell you, they want to actually help you when they're on your side. So we want to make sure that our clients and your listeners know not to sign an assignment of benefits.
and more of the unscrupulous part of this industry that at times has made premiums higher. So hopefully there is legislation in place to help correct some of this and benefit the public interest. Well, whether it's legislation that helps clean things up and normalize premiums some more, or any other industry changes, are there any trends or anything that you see coming down the pike, Doug, that might affect people, especially real estate investors, with respect to their insurance?
Because of the issues in Florida with the roofs, with the roof claims, we are seeing a lot of carriers starting to talk about having a depreciated scale on the roofs. Instead of it being a replacement cost in the future, 15 years after you've had the roof, at some point it will hit a depreciation scale. So they'll start paying actual cash value on your roof. That has to do with the wear and tear. They don't want to have to pay for the wear and tear on the roof. Your roof is eventually going to wear out in Florida faster than other places because of our weather here. To kind of mitigate the frivolous claims that they're having with roofs, they're looking to go to that model of, after a certain point, it makes more sense to start depreciating the roof, and so you'll get a little bit of a less payout if you have an older roof and you have a claim.
Well, Doug, are there any last things about the insurance industry that someone needs to know? Maybe something that I did not think about asking you about, especially when it comes to real estate investors in insurance?
It's good to have a good agent. So when you think of your team of people that kind of surround you when you have investment properties, you're going to have somebody that possibly does repairs, does maintenance, possibly rents out your property for you, all that type of thing. Make sure you have a good agent that you can go to for advice, that can take a look at those houses that you're looking at possibly buying. A good agent will be able to say, hey, this is going to be less expensive or more expensive because of these features of the house or this area or whatever the case may be. But make sure you have a good agent as part of your team.
Do you ever do quotes for investors before they've ever closed on a property, just so they can get an idea of, if they do purchase that property, here's what the insurance premium will be? Do you do that?
Yeah, sure. So if someone's looking at buying several properties, we can take a look and give at least a ballpark of what the insurance may be. It may or may not impact the decision to buy, because sometimes insurance is kind of an afterthought, but we'd be glad to do that.
Yeah, oftentimes that prospective buyer can get an estimate from their turnkey provider. If they want to know it more closely, they can get the insurance company involved to try to find out what that premium is going to be. Well, Doug, this has really been helpful in getting updates on the insurance industry and just what investors know that they need to keep in mind. You mentioned the states earlier that you do provide coverage in. If someone is looking for coverage, potentially through Fudge Insurance, what is the best way for them to start and go about doing that?
They can go to our website. That's the easiest way to request a quote. It's www.fudgeinsurance.com. Right there in the front page, there's a request a quote button. You push that and we will get it to one of our agents and have them contact you and get a quote in your hands. You can also call our office at 407-965-4253, and we'll be more than happy to help anyone out.
Doug, thanks so much for helping our audience. It's been great having you here on the show.
Thank you, Keith. I appreciate it. It's been great.
Yeah, a lot of important insurance considerations from Doug, really talking more about protecting your downside is what we've done here today, lowering that insurance expense. Part of that is making sure that you're not over-insured as well, and that's what can increase your cash flow. With high property appreciation like we've seen lately, that's obviously good for you overall, but you got to remember about those higher material costs that can put upward pressure on premiums when it comes to replacement costs. Yet overall, it's still a fairly small expense here in that grand scheme of things. Next week, I expect that we're going to talk about available turnkey property here in an exciting new market, a new city that we have not talked about before on the show. In fact, it's quite possible that I have never once uttered this city's name on the show before, which is really quite remarkable. Investors really want to know about available property like this. Hey, remember to sign up for our wealth building Don't Quit Your Daydream letter. Every word really is written by me. The letter wires your mind for wealth. It helps you make money in your sleep, and it updates you on important real estate investing trends and is chock full of real opportunities. It is free at getricheducation.com/letter. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.